You're listening to Real Investor Radio with Craig Fuhr and Jack Bevere, where we cover advanced real estate investing topics to help you stay ahead of the curve in your real estate investing business. Well, welcome back, everyone, to the Real Investor Radio podcast. I'm Craig Fuhr, joined again by Jack Bevere. Jack, it's good to see you. We were out late last night.
Yep, we found this. There's this little local place in Odenton, south of Baltimore, and they've got the best barbecue and one of the widest selections of bourbons that I've been to. And so we partook in both and had a great time.
Can't say we tried them all, but we tried quite a few.
We tried,
and I can't wait to go back. So, got a couple things to talk about today, and we have an amazing guest. And Josh, we'll introduce you in a minute, man, but we got a couple news stories here based on some prior episodes that we've done that I just wanted to touch on quickly, man. So jump in if you want to comment, and then we'll jump into your story. So, Jack, we talked with Doug Stein a few episodes ago, famed tax attorney. You've known Doug for many years, and I'm sure you and Fred have used his services quite a bit. But we talked on that episode, Jack, about the Corporate Transparency Act and what that meant for folks, especially real estate, as we discussed on the episode, was passed by Congress as an anti-money laundering initiative in 2021. Basically stated that reporting companies defined as corporations, LLCs, and similar entities must disclose the identity and information about beneficial owners of those entities. And so for new entities incorporated after the 1st of 2024, they must report and disclose the identity of the applicants. The fines for that, Jack, are hefty, as you might imagine, $591 a day for not reporting, up to $10,000 and 2 years in prison. So, interestingly, a federal court in Alabama just ruled that act as unconstitutional. The district court granted the plaintiff's motion for summary judgment about a week ago in the case of the National Small Business United versus Yellen, and basically said that it was unconstitutional. Obviously, there will be appeals. Federal government's got some deep pockets to go and fight that. But I think Doug got back to us, Jack, sort of on his feelings on it, and I was wondering if you wanted to comment.
Yeah, so the implications of that are that it was the case that everyone will still have to register the LLCs that they own. Now, if you have like 50 LLCs, it becomes kind of a burdensome chore. Right. And the intent is for the government to really kind of like eliminate the anonymity of hiding behind LLCs with lawyer resident agents and undisclosed operating agreements, or even trust agreements that where the nature of the trust and the rules of the trust are rarely disclosed. The government wants to be able to see where's the money actually flowing to in terms of the human beings.
Correct.
And so Alabama thinks that's an overstep. But the federal government, and so Doug's take is that it'll likely be appealed to the Supreme Court. But in the meantime, the government came out and issued a ruling stating that they'll be exempting that plaintiff, but everybody else it still applies to. So the government is coming right back over top, the Alabama court, and saying, hey, we're going to go fight that out. But in the meantime, no, you need to go still file. So if you see any news reports out there about how the Alabama court has ruled this thing unconstitutional, don't breathe a sigh of relief quite yet. We're going to watch as that plays out in the court system. But in the meantime, the government's taking the position that you still have to do those filings this year. And for existing LLCs, we have until the end of 2024 to make those filings. So it doesn't take a lot of time per LLC. Mm-hmm. But if you have a bunch of LLCs, don't wait until December 30th, because sure, things will slow down and the website will get crashed or some junk like that. But Yeah, so we'll keep you guys apprised of as that unfolds. But it was interesting to see that play out.
Well, if you want more information on the Corporate Transparency Act and sort of its effects, its ramifications, and just information in general, I would urge everyone to go back and take a listen to two great episodes with Doug Stein. I've had so many folks comment on those two episodes, Jack, and it was great content for folks to check out. Second news story, a little bit more on the macroeconomic side, Jack. Horrible PCE inflation report. The Fed needs to hike in March. So January core PCE inflation, Jack, which is basically a measure of durable and non-durable goods and services. Inflation was reported at 0.4%, the highest since February of 2023, indicating a possible acceleration of inflation. And more specifically, the services side of things rose 0.6% in January, which was the highest increase in the last 12 months. And so, they're speculating that, we'll probably still see maybe a couple rate decreases in the, around June, but maybe not. And so wanted to get your take on that.
Yeah. So it was really interesting because Powell had came out in December talking about how we were moving in the right direction, and the new consensus in the Fed was that that we would likely have rate cuts in 2024. The consensus, the dot plot for the Fed, which is what they could use to kind of indicate where each of them are thinking, each of the Fed governors is thinking. The median was 3 rate cuts before the end of 2024.
Mm-hmm.
And so the market just, got super giddy about that, the end of the rate tightening cycle. And, the stock market took off. Mortgage rates came in because if inflation is under control, then mortgage rates long term are going to come down some. And then, a month later, well, really it was just a week ago, but the January data for inflation for PCE came out, and it's 0.4% on a monthly basis.
Mm-hmm.
So that's 4.8% for just PCE. That there's other components of CPI that are even a little bit higher. So that's kind of throwing a wrench into the Fed's plans for a nice smooth landing and coasting into 2% inflation. And so now Powell, immediately Powell comes out after that and says, hey, what, we're just going to follow the data. I didn't promise any rate cuts. We're just following the data. I've always said that I was going to follow the data. So he's backpedaling. And so we'll see I guess we will continue to watch that data to see what's going to happen. Mortgage rates increased based off of that news, which sucks. And that's been frustrating. And now I think it's actually this week, which was probably when by the time you guys hear this a week or two ago, Powell is speaking today, actually, in front of Congress. So we'll see what he says today. And so it's TBD right now as to whether we're going to see any rate cuts in March or even June. Obviously, because of the impact on mortgage rates and the potential impact of mortgage rates on the housing market, that's something that we're following very closely.
Real estate investors live in a world of goods and services. And so while goods appear to be still, falling, the price of goods, services, they're saying, is very sticky right now. And so we haven't seen any significant decline in services, Jack. In fact, they've remained largely the same since COVID and appear to be even increasing at this point. So, yeah.
Yeah, and that feels right to me. Like in terms of like the cost of labor, we've seen some decreases in some categories of materials, but labor in general has not. Maybe in the third or fourth quarter last year, we saw a little bit of softening. People were getting a little bit concerned, and so we could get some. And work was drying up a little bit, maybe just because of the seasonality of things. But labor is not something that we've seen. Certainly not drop in terms of price. So we're still dealing with an elevated cost of, replacement cost for building houses and renovating houses.
Well, we'll keep an eye on it. It was good good to start off the conversation here, but let's go ahead and introduce our guest for today. Excited to have him here, Josh DeShong. Josh is the founder of Josh DeShong Real Estate, Myers Home
Mouthful.
Buyers. Huh? Yeah, man.
I said it's a mouthful.
You've got a lot going on, brother, but we're going to jump
Yeah.
in all of it. And also the founder of Trelly. So, Josh, welcome to the show, man. It's great to have
Thank you so much for having me, guys. It's awesome to be here.
Yeah, dude. So if you could, I mean, we've known each other for a long time because of the Real Investor Roundtable mastermind, and I've always been really fascinated with the stuff that you do because, frankly, it's a lot of stuff that I don't do, and you've done it on a very high, all of those things on a very high level. And I'm always fascinated the way that you think about problems, think about the world. You've got a really fascinating background. And your career has been a really interesting story. So if you would do me a favor and just
likewise,
if you do me a favor and just give folks a background, maybe like a quick couple minutes on how you got into the business, and then just the evolution of the different businesses that you have started over the years, and bring us up to speed on what you're working on now. That'd be awesome.
Okay.
And if you could somehow try to explain the fact that you appear to be about 23 years old and have done all of this in that time period is really the part that I'd like to get into. So,
oh, that's funny. That's great. Thank you. I don't get called. So I got into the business when I was. So I got into real estate school when I was 17. So I don't get called young like I used to. Everybody would be like, "How old are you? How old are you?" I had this baby face, and now I'm starting to come to age, and I'm not like the young guy anymore, and it's a little weird. I'm not gonna lie. Guys, thanks again for having me on the show. I started almost 20 years ago, 18 years ago in this space. So out of necessity, it was 2000, probably 2005. I was working for my dad at his furniture store, and I was reading a business journal, and it was talking about how great residential real estate was, and I was like, okay, fantastic, that's what I want to do. So I went and enrolled in classes. It was a total fluke thing. I didn't know anything about real estate whatsoever. Went and enrolled in classes, and yeah, I actually did all my coursework while I was 17. When I turned 18, I could finally sit for my state licensing exam. So I sat for my exam, and I joined Keller Williams. And I always look back and laugh. I was so naive. I was so young. I didn't have any experience at all. I mean, I didn't at that point. I obviously didn't even do college, right? So my experience level was nothing, and it was phenomenal because I didn't know what a bad market meant, and I didn't know what a good market was. And so that ended up serving me in the long run to a serious advantage. So I get licensed, I get rocking and rolling in 2006. I was, it's funny. I don't know how I sat for my real estate test, guys. I didn't even know what earnest money deposits were or any of those things when I had after I got my license. And I was like, I cannot believe I actually passed that test. But there was one thing, I got a really good piece of advice, and it was call expired and canceled listings. And so I obsessed over that one thing. Every day I would call as much as I possibly could. There's actually a photo of me at my desk. And I noticed something the other day. I had 3 phones on my desk because I would dial off of each one. This was pre-auto dialers, right? Yeah. And I did that for 2.5, 3 years to really kickstart my career. And it turned out, by year 3, we were in the top, probably the top 1,000 at Keller Williams, and maybe top 500 or so. But by year 5 or 6, we were ranked in the Wall Street Journal. We had a pretty massive business, and I attribute a lot of that to just getting in timing wise. I got into kind of a bad market, and I just learned how to work really hard. So when the market started doing well, I was just used to working hard, right? It kind of set that standard, that benchmark for me. So
we talked with a few weeks ago. We talked with Austin Carroll, and Jack, do you remember how he was talking about his initial foray into real estate? How he would make he went out on this crazy, and I think it was a Keller brokerage, if I recall correctly.
Yeah, he's
Jack,
also Keller. Yeah,
where he decided to get into a competition where they would talk to, was it 1,000 or 10,000 people, Jack? It was like some ridiculous.
yeah.
And so, it sounds like a very similar trajectory, Josh. And so, yeah, amazing. I have always said that Keller is more of a coaching company than it is a real estate company,
For sure. I to this day give Keller Williams a ton of credit for like my upbringing, because really like my real estate team, my brokerage team, that was my college, right? Like that's where I learned everything.
Right.
You know what I mean? So, I went to the school of Keller Williams. That's what I should put on my LinkedIn education. I should say I attended Keller Williams for
That's
11
your
years.
MBA in Keller.
Yeah, exactly. So, and then, one big thing, and Jack, we've talked about this. One thing about me is I know that I don't know everything. And so I'm constantly asking questions. I'm constantly seeking mentorship. So very early in my career, I sought out mentors. And by 2012, so roughly 6 years into my career, I had two or three people that I really looked up to and would seek advice from. And this could be, business advice, spiritual, advice, just anything, just for guidance, right? Like mentorship is probably one of the things that I like, one of the few things I got really right. But in 2012, a mentor of mine says, Josh, services is hard to build wealth. You need to build products or you need to acquire assets. It's one or the other. Those are the only real two paths to building something and actually have wealth at the end of the day. And I took that very literal. So within 2 weeks, I probably had 2 houses under contract, one of which I actually still live in to this day. So,
nice.
Within 2 weeks, I bought two flip properties, and I finished those out in 2012. In 2013, I did over 30, and I was just coming across them in our traditional real estate business. In 2014, I did over 100, and I started actually wholesaling out of necessity. So Myers, so we had our brokerage business, Josh DeShong Real Estate. Then we started what was DFW Home Buyers, and we were flipping properties here and there, and we started wholesaling off our excess inventory. And then fast forward a few years, and to 2017, we're doing hundreds and hundreds of wholesale deals a year. And we decided, hey, I don't have the capacity to actually invest in property anymore. So we went exclusive wholesale. And it also was good too, because we wanted our investors not to feel like we were competing with them, like they were getting our scraps or our leftovers.
Right.
So in 2017, we went exclusive wholesale and we launched Myers Home Buyers. And it's a large wholesale operation based in Dallas, Texas, that right now we're pacing for about 500 transactions this year. It's only March, so you never know how this year is going to go, especially with the who knows what the Fed's going to do, right? So, so originally as a kid, before real estate was ever around, I was a little bit of a nerd growing up. And so I was always into computers. I got my first computer at 8. So I had learned to program. I had learned to code quite young, taught myself most of it. I sat for my A+ certification, which was kind of like the original Microsoft certified when I was 13. So I had a little bit of a technical prowess, and I used that a lot as I was going and evolving and building my different businesses. Well, in 2016, I encountered a gentleman by the name of Stephen Chang, who was an engineer at Google at the time. And he actually joined me in our company, and we've built all kinds of different tech products, internal and some external that we've licensed externally. But a really cool one that we were really excited about is Trelly. And Trelly is a marketplace for wholesalers. So just like Myers Home Buyers is a wholesaler, there's not a formal playground for us to play on. We still operate off Facebook, email blasts, text blasts, things like that. So we designed a marketplace that helps connect investors to real wholesalers, rates the wholesalers. They can get reviews and ratings from their clients, from their database. And yeah, that's something we're really, really excited about. But that's like our tenure. That's our tenure game, is what I call that.
So how did you
a lot.
by the way, just out of curiosity, where did the Myers brand come from? I mean, it's very catchy, Myers the home buyers.
It rhymes.
It rhymes.
It was between Myers Home Buyers and Schmitty buys shitty houses. I couldn't. I was struggling at figuring out which way I was going to go there.
Well, I know what the name of my company is going to be now.
I'll be honest. I would love to run those ads. That would be so much fun.
I want to see the bench right next to the Homebusters bench. Yeah, like the right.
So
it'd be so great.
Growing that wholesale business, obviously the market was a lot different in the mid-teens, but that's no small thing, the amount of transactions you're talking about. And so like how did you go from you wholesaling yourself, just finding stuff maybe on the MLS or like sending some direct mail, to actually building a company that's doing it? How do you recruit the sales guys? How do you keep the sales guys? Because, wholesaling is not one of the appeals of that business model is that it's low barrier to entry. So how do you, like, if you find a really good salesperson, keep them in house as opposed to them going off on their own? Like, talk to me about that kind of stuff, because I feel like people have a hard time building one of the hardest things to do is to build an acquisitions team, and there's lots of investors who have stories of getting burned by somebody they mentored for 2 years and then dipped out on them.
Mm-hmm.
Yeah, I will, and I will say I don't think there's a world where that ever will go away. I think at the end of the day, every investor, wholesaler needs to accept the fact that if you hire talented people, you are likely not a destination. You are probably a layover. Right? Like, otherwise you have to give them upside. There is nothing that you can do to retain them if you do not give them upside. Look, winners win, period. Right. And I think it's silly for us to commoditize people. And don't get me wrong, like, in all honesty, I've tried to in thinking about how to evolve the business and thinking about recruiting people in. And then one day I just kind of had to accept that, like, hey, I just need to enable people to do as good as they possibly can and treat them as good as they possibly can and give them and build. And so this is where the technical components come in. Build things that give them an advantage versus if they were on their own. Right. But then it becomes, is that defensible? Is that thing I built defensible, or can they go out and license it from somebody else? And so that's when, training, helping guide them and helping them achieve things, like, that's when additional value comes in. But again, at the end of the day, layovers versus destinations.
Jack, in all of your years running the ship with Fred here at Dominion, I know you guys have gone through the similar growing pains of sort of finding the right avatar and the right compensation for great people. And maybe you could just talk about, like, sort of the evolution of what you guys have discovered over the years of finding, attracting, and really keeping great talent.
Yes, so I definitely agree with Josh's sentiment. Frankly, that was like, when Fred, when I joined Fred, that was the deal. I was like, hey, I'm here for ups or I'm out. Now I've always, I don't know if I've always struggled, but I think there's an important distinction though, because some people say they want ups. Like, so if you want to be on the operating agreement, well, you get the ups along with the downs. And there's a lot of people who say they want ups, but they're actually not willing or frankly not able to take downs. Like, they've got a family, they've already made decisions in their life where they've got a family and a mortgage and and a lease payment on their car. And so, they've got a lifestyle that they've, like, become accustomed to. And so they need a base that starts here, but they also want ups. Well, America. So, like, if you want upside, you got to take downside. And so finding that mix of, like, folks, and so we've ended up, like, I've really struggled with this over the years, right? Like I think 10 years ago, I was thinking like, hey, let's do like an employee owned company. Like, let's turn this into an employee owned company, because then everyone will have, everyone will be, really be invested in it. And we're recruiting folks who think real estate investing is interesting, but they've got their piece that they do well. And if we all like just make this place where we've got all these different people who are the experts in their field, and we all like kumbaya and work as a team together, we'll all do better, and we can all enjoy the upside together. And I and that downside issue kind of smacked me in the face, because I was willing to work for beer money, but other people weren't or aren't able to work for beer money with upside, and that's been a challenging thing. And then I've had folks who were just who have stopped through over the years, and come in saying they're here ride or die, and then dipped out like 2 years later, regardless of the structure. Even if I'd like structured something that I thought had considerable upside, they were never really here for the long term in the first place. And I don't know, it's definitely something that I've struggled with. I agree with Josh's sentiment about building an environment where you're adding value so that they can do the things that they do well, and they don't have to do the things that they don't like to do or don't do well. Part of that gets into maybe even a deeper conversation of like what people are, what understanding, people being honest with themselves about what they're good at and what they're not good at. And that can be a difficult conversation, because a lot of folks will tell you they can do everything, right? And it's just not true. I also used to think that I could do everything, but I've since learned that is also not true.
Oh, Jack, you're just being humble.
It's funny. I was listening to you, Jack, say this, and it's like we really all are out here just living the same life. It's just on repeat or something. Because it's like, I've done the same thing, and it's like it's surprising how much employees value, don't value upside or value immediate compensation and no upside. And so it's just like everybody has these different triggers, and if just accepting like, hey, there's going to be these different levers, I guess I can pull with every person, takes a lot of the minutia out, it takes a lot of the extra thought out. It's less gamified, but it builds a stronger culture, I think.
So what's the Myers structure look like, right? So I'm sure you got salespeople who are answering the phones, but behind them, what is there that behind them to make that happen?
Yeah, what's making the phones ring?
Yeah, so there's actually not. We have an answering service that answers all of our calls, or the leads come in via our website. From there, we actually have a proprietary lead routing system that looks at it looks at two things. It looks at, one is the client side. So the person that submits the lead, what's owed on the house? How long have they owned the home? What is the overall score of that lead? What is the quality of that lead? That's happening on our website, actually. From there, we then send it to another engine that looks at our acquisition associates. It looks at their revenue efficiency. It looks at how many leads they've been given, what was the overall score, and how are they doing. And then it distributes that lead out to that person, whoever that is. At that point, our team reaches out. Our acquisitions department will reach out. Somebody will go out, meet with the homeowner. So we do all physical in person. There's a lot of, I think this virtual wholesaling is like the new hot thing. We are not virtual. We are the opposite. So we have an acquisitions associate that actually goes out. They meet with the homeowner. They'll walk them through whatever. If there's an issue on title, which is a substantial amount of our files, they will start the curative process. We'll go under contract with that homeowner. At that point, our team then does two things. One is we have the Trelly database, the Trelly marketplace. We post the property to Trelly, and then we have a dispo team, or our sales team is what we call them. And sales, their objective is to engage with real estate investors and just connect dots for opportunities. So we've got roughly 20,000 investors that we are actively engaging with in the last 12 months. And of those, our sales team will start drumming up interest on those properties. We take all of our bids through our Trelly platform, through the marketplace. And investors will bid on that property there, and we end sales kind of like an eBay auction. Does that generally make sense?
Yeah, yeah,
Sure.
yeah.
Absolutely.
How many? So how many sales? Like, how big is the team? Like in each category of folks, how many people are there?
There's 15 people, roughly 4 in acquisitions and 11 in sales.
Wow. And then
So the way we think about it is sales is kind of like our entry level. Like sales is where people come. That's where they kind of like earn their stripes. Then they go into acquisitions, and then the goal is to get them to go into management or leadership.
Interesting. And what does management and leadership look like? I mean, I know you guys do a lot on the tech side of things, so that's got to be. Is that, do you consider that like a department, or do you have like a guy?
So, well, no. If you go into management or leadership, the hope is you're running your office, you're running your own market center, and you're getting some sort of an upside, some sort of profit share incentive, and that's really the only way that you can keep leadership. We've tried scaling without doing it that way, and to y'all's point, once you train somebody good enough to leave, and then you're not paying them what they can now go make on their own, they're going to leave. So scaling when scaling that model doesn't work. So now we're about to go open our second office again, with a GM, somebody who's actually earned their way up through the ranks. They've kind of gone through this process of advancement, if you will.
Interesting.
When you say second office, are you still staying within the Dallas metro, or are you branching into other states?
No, so we had a couple offices. We had Dallas, Fort Worth, Houston, and Tampa. And then when 21 came, things got really, really tight. And we decided to cut bait on anything that wasn't core revenue, like our core focus. So we bailed on on all of our other markets except for the DFW. So now we're going back to Fort Worth, and then we'll probably actually do a third office in Dallas by the end of the year, and then we'll start our statewide expansion. Then we'll go back out, probably hit Florida.
Go ahead,
what's
Jack.
lead gen?
I was going to say, man, in an era of low transaction and, everybody complaining that it's like finding a needle in a haystack, how are you guys centered in one metro area and able to do 500 transactions?
So that's where I think our competitive advantage is from a tech perspective, because everything we do, we try to make it, okay, let me, I'm embracing qualitative, but I'm very quantitative. So I try to use data to make decisions. So we have feedback loops built into like our CRM. So for example, I would realistically pay $500 for a lead, no problem. I would realistically pay $1,000 for an appointment, no problem. I would realistically pay $20,000 for a $20,000 fee, right? So what's happening in our CRM as this stuff is happening, we are getting different. We are sending back, like, for example, to Google, we're sending back different values for every lead that we actually get. We're sending our website different values for every lead that it's actually putting into our CRM. That is allowing us to really optimize and effectively pay our people with leads rather than pay them with money. So if you do really well, you're going to get more leads than if you don't do well. Does that generally make sense? So that's where, because I can go out and spend 500 grand on marketing, but the problem is people can only work so many leads at a time.
We were just
but then they can only work.
Night.
Yeah, they can only work we've found they can only really work between 25 and 45, ideally. After that, conversion rate starts to drop. So if you're not focused on really optimizing conversion rate, you can't scale up how much you spend in marketing.
Are you optimizing feed? Do you have I mean, I'm not sure exactly how one would execute this. Of course, we can put a man on the moon so we could figure this out, but maybe you already did. But like, are you saying that like a lead goes through the system, gets, from a particular lead source, gets sent to a particular acquisitions person, and they make, they dispo the sales guys dispo the thing, and they make 20 grand on that, and you feedback loop the system to be like, hey, we made 20 grand on that. Like you only paid $1,000 for that thing, or you only paid $5,000 for that. You could pay $6 and like ramp that up to try to dial that
Right.
up. So like as you're getting a feedback loop from the system, and so you're dialing up different areas of the funnel based off of the feedback loop of what's coming out of the bottom.
Bingo. Yep, that's exactly what we're doing. And it's the only way I've been able to figure out how to scale. So every time we've tried to scale marketing and the number of leads that we're actually getting, we start to lose invisibility in the management of what's happening with all the different leads. Then things like we'll have salespeople that'll steal stuff. Loss mitigation is another topic we could get into, but we'll have salespeople that will call up one of their buddies and be like, "Hey, I got this deal. You need to lock it up. You need to buy it and throw me a fee under the table." Right? So like all these different new problems get born as you try to scale, and that you don't foresee when you're doing 50 or 75 units a year. And so you have to at my stage, what's most important is optimizing that conversion rate and not letting like what would happen a lot of times back in the day is somebody would start doing bad, and we had them on an even round robin of how we were distributing our leads. Well, when they were doing bad, we wouldn't realize it, but 6 months would go by, and this person would have cost us maybe hundreds of thousands of dollars, and we never even thought about it.
Yeah, an opportunity cost. Yeah,
and maybe they were just going through, maybe they were going through something personally. Maybe or something that also happens. They make a bunch of money, and then they want to take 2 or 3 months off.
Mm-hmm.
That happens a lot. Well, I don't want to keep giving them leads. I want to change who I'm giving those leads to. So by having a real-time system that's now managing distribution, and then also has a feedback loop to ultimately score what the lead is valued worth, that helps us keep the conversion rate high and also keep increasing our overall spend.
What level of granularity are you guys doing? Did you create a scoring system? And if so, what level of granularity are you guys using on that scoring system? Like obviously, like pay-per-click based off of this word, but like, are you doing also like who picked up the phone, or the script that was used, or anything about the nature of the lead? Like what level, how nitty gritty do you get there before you're like, hey, yeah, this is like good enough?
So we'll look at indicators like how much was owed on the home when they bought the home, number of occupants in the home. We will look at mortgage date, last recording date. We look at quite a few different variables. And really, we're learning off of this constantly, right? We're trying to identify patterns so that way we can use those patterns to our advantage.
How much are you taking a look at sort of what the motivation was?
Not nearly as much as you would think. So because we call those subjective variables, and subjective variables can kill any kind of pattern recognition. Like for example, you ask your salespeople, rate a lead, hot, cold, whatever. What I call hot and what someone else calls hot will not be the same. It never is. So those types of variables, motivation, if the husband calls in, they're less likely to say real motivation over the phone, whereas if the wife calls in, she's more likely to say it, right?
The reason why I ask is, Jack, we had that fascinating discussion with the guys from Audantic and sort of what they're doing to identify motivation in ways that people may not have thought, and sort of much more, and really taking a look at the demographics of particular sellers who, in terms of patterns, find themselves in, situations where they're more motivated than not. It's obviously a business of motivation, right? And so
Yeah, Josh, where would you like? I mean, you know Audantic well. Where do you use them? And then follow up to that, where do you differ philosophically from them in terms of how you think about optimizing a lead gen channel?
I don't think I differ that much, actually. I love Chris. Audantic is, we've worked with them in the past. I would say they're probably one of the best when it comes to identifying um, people that have the highest probability of selling. In Texas, so I'm in Texas, it's a non-disclosure state. Audantic isn't able to do the same thing as in our state that they can do in other markets. So
Dagger.
if you're in Florida, or you're in pretty much any other state except like 8 of them, then you can back into a motivation based on, probate filings, based on water cutoff, based on, you can do things like that a little bit easier. And you can still do a lot of that stuff in Texas, but it's not as robust.
But you've built that like determination of, you've built that feedback loop right into right into your acquisitions pipeline. So you're feeding your acquisitions pipeline data in real time, which I think that's a super powerful idea, because I love the idea of looking at public record data and saying, hey, who sold? All right, who else looks like the people who sold?
Yeah.
And find me more of those people. But also, like, the market changes, right? Like but what that doesn't get you is, it gets you what it gets you is a retrospective vantage point on who's selling, right? And so, like, whereas, if all of a sudden some scary thing happens in the news and a certain psychology, right, of seller says, hey, you know what, now it's a good time to sell, right? Because they read on wherever that, like, now is a good time to sell. But the values are capped, but now is a good time to sell. If you were thinking about, if you've been sitting on the sidelines, do it now. You'll get that feedback, like, in real time, right? Like, as the guy is closing the deal and you're dispoing something, you're like, hey, this just worked. And anyone looking at public records data will see that 2 months from now, and in an event of a non-disclosure state, or not at all. So that's super interesting. Yeah, I like that a lot.
Yeah, and and don't get me wrong, in the non-disclosure state, you can still get like probate data, but you can't get as much granularity as you can in some of the other states.
So what CRM are you using for everything you described? Did you build it yourself, or you build it on some backbone?
Fantastic question. We started back in 2017. We started trying to build our own CRM, and we cut bait on that because our ideal CRM is
Non-existent.
yeah, it's basically Salesforce, and so it's like, okay, so are we going to build Salesforce? And that did not seem to be a viable proposition. So we played with Podio, we played with Zoho, we played with a couple different platforms. Ultimately, we decided on Zoho for a few reasons. It was extremely flexible at the time. Zoho was like this up and coming bootstrap startup, but they were doing really, really well.
Mm-hmm.
And then Citrix had stopped supporting Podio, so that kind of freaked us out in terms of long-term viability. So we built out a custom instance of Zoho, and over the years, it's actually been great because they've added more and more to their suite of products. So a $40 a month per user seat on Zoho is the equivalent of like a $400 per month user seat on Salesforce or something extreme. Like it's a lot more cost effective for us. It seems relatively user friendly. It is relatively user friendly compared to your Salesforce, but it's still a startup in all honesty.
Interesting.
Yeah, we've certainly had our growing pains with Salesforce. I would wonder, how much, where do you find the people to do the customizations, and how much time and money have you spent on that for Zoho?
Man.
It's a robust platform for sure.
Yeah, it started with me doing it because again, remember I said I have some technical chops, and so I started building it out like what was the minimally viable CRM. And at first, it started as just a leads and a prospects module, and then I added a pending properties, and then it became all these different workflows, and then Steven, our CTO, got involved, and then it turned into a whole nother thing. So we've also had people that, CRM managers and stuff on salary. I would say we've probably spent since 2017, 2018, we've probably spent 450,000 on it. Maybe 350. Three somewhere between there. I don't like to think about it.
I always love when Jack gets that nostalgic smile on his face. Like,
Yeah, I don't want to look at what I've spent on Salesforce in the past 2 years either.
And Salesforce is by far the most robust, and it can do things that nothing else can do. But man, they are proud of that product.
That's what I keep telling myself.
I've always said it's the it's the Photoshop of CRMs. It's this crazy robust platform that can do a million things, but most people only use about 100,000 of those things.
Yeah. You need Paint, and you got Photoshop.
Right.
Yeah.
Cool. Well, hey, Josh, I want to jump in and talk about Trelly and that experience and the marketplace. How you guys have built that out and that experience. But we're running up from a time point of view, the end of this episode. Craig, you want to take us into the next?
Yeah, sure. I'd invite everybody to join us for episode 2 with Josh DeShong, where we will talk about this great marketplace for wholesalers that he's bought. I'd love to hear sort of like the genesis of the idea, how you followed that through to the actual product. I'd also like to talk more about the real estate investing that you do, and sort of how you manage it all. And so join us on the next episode with Josh. We'll end this one here. Thanks for joining us, and we'll see you in a bit for episode 2 with Josh DeShong.